Plan Subcommittee of May 2nd. With that, first order of business is a review of the minutes from February. Does anybody have any comments or questions about the minutes?
I did not.
Hearing none. Before I kick it over, I would just be remiss without mentioning that we do have a budget referendum tomorrow, Tuesday. So everybody get out and vote tomorrow on the budget. If anybody does anybody have any questions about that, or any questions before we hand it over to Chris? All right. Without further ado, Chris, the floor is yours.
Great. Thank you, Mr. Chairman. Good morning, folks. Great to see everyone this morning. Did we want to, Melissa, were you going to bring the package up on the screen?
Do that.
Make reference to, the highlight pages that we need. I guess I would offer up to the group as a precursor. You'll remember we ended 2021 on a pretty solid note with portfolio performances for the pension plans and the OPEB trust steaming along. I think an annualized returns, hovering around 10% and fairly consistent incremental return over benchmark, nominal, but incremental and consistent nonetheless. Certainly we'll talk about momentarily here. I know this is probably old hat for the group. Q1, it proved to be extraordinarily difficult in the markets, I think, as you all know. And unfortunately, the downdraft was indiscriminate in the sense that both equities and fixed income sharply for a whole host of reasons that we'll unpack here momentarily. And it proved to be, maybe no surprise, a difficult environment for the managers to navigate as well, because under the hood, in that kind of fairly consistent downdraft start to finish in capital markets, was all kind of a whole host of volatile circumstances, whether it was style or factor or quality or domestic versus international or big rotations in and out of sectors and the like. It was a very, very difficult quarter, as we'll see. And unfortunately, some of that has carried over into April as well. So I think as we sit here this morning, for those of you maybe over the weekend who glanced at a newspaper or whatnot, and you looked at returns, just a note here for you from a broader context perspective, the S&P as of Friday night down 13% year to date. Small cap stocks in the US down a little over 16% year to date. International stocks year to date down a little over 11%, actually outperforming the US on a relative basis. And then lo and behold, right, maybe kind of most troubling for diversified investors like we are collectively, bonds, given what's going on with interest rates, down, the aggregate bond index is down 9.5% year to date through Friday night. So that's obviously tough sledding in capital markets right now. And again, we'll unpack some of those details momentarily. If you could, Melissa, just quickly on PDF page 5, if you would, just I'd be remiss if I didn't. For those of you who have an interest, we are having our conference in Newport in the middle of June there. You're certainly all welcome. We'd be delighted to have folks out. I think we've got a pretty good day scheduled. It kicks off, as you see there, the night before with a clam bake and some other social activities. So certainly, if there's interest there, let us know, and Tyler and I can help you get that organized. If you would, Melissa, jump to page 8. I think it's PDF page 8 is where the capital market information starts, the higher level information. And we talked, I hinted, I think, a little bit already, but you see there, what's of interest to us, I think, in the upper right-hand corner of the page, you'll see what we've done there is just highlighted Q1 capital market outcomes 2022. And you see that in the blue shade. And this is back since 1976. You'll note that we've had about 16 quarters since 1976 when both equities and fixed income were negative. And you see there pretty squarely so, as mentioned in the first quarter of 2022. A couple of observations there. back from the early 80s, actually, that are kind of somewhat adjacent to the outcomes in this quarter. Incidentally, they kind of coincided with the onset of recessions, which we don't think is the case right now, but it's just an interesting side note. Nonetheless, right, the visual there is, I think, a pretty stark one and a pretty telling one, that these types of circumstances don't happen all that often, and really driven right by all the reasons that you've been reading about, right? Whether that is the Fed trying to navigate and stamp out inflation and having to use interest rates primarily as the tool to do that. Obviously, the conflict at the beginning of March in Europe set investors a flutter for sure. And there's a whole host of things that have been navigated by investors, and it's been somewhat of a struggle. I mentioned earlier that we don't think, as we sit here today, that the world kind of falls into recession. You see in the lower left-hand corner of the page there, a little bit in the way of estimates. This is a UN a set of data, and you'll see there kind of year-end 2021 expectations for economic growth around the world, and then a take on it post-crisis in Europe. You see the estimates there in the middle of March time frame, and certainly, right, kind of headline or headwind effects, I should say, and expectations for more modest growth, but growth nonetheless. And we do think, as kind of things sit here, that we think that the world will continue to grow at this somewhat diminished pace, but grow nonetheless. And that's an important consideration from an investing standpoint, as we'll talk about in just a second. What's not on the page here, but we've talked about it in the past in this setting, as you'll remember, is consumer financial health, and it being at all-time highs right now. So I think during the pandemic, there's some estimates of something like $2.5 trillion of excess savings that's been created since the onset of the crisis. And anecdotally, right, if you look at a lot of these high frequency data points like restaurant reservations and travel plans and cruise ship bookings and hotel bookings and the like, they are running at extraordinarily high levels, and maybe indicative of some pent up demand. So we think that all comes together in a manner where we've got some pressures on economic growth globally, but not a complete recessionary outcome. And I say that fully recognizing that you've all probably read last week that the Fed, the estimates, a recent estimate on GDP growth was negative, in fact. You'd say, how does that work, Chris? And again, I don't want to bore the group with too much in the way of detail, but you look at things like retail inventory buildup at the end of last year, and you look at the trade deficit data, which were kind of the contributors to that number. A case can be made that number may be a bit transitory and maybe re-estimated in revisions a bit higher. So we'll keep you posted on that. And then you see there in the lower right-hand corner of the page, and then we'll transition over to the portfolios. This idea, again, the other thing that folks have spent a lot of time talking about, you'll hear economists mention this idea of inverted yield curves being a precursor to recession as well. And as you all know, the yield curve is extraordinarily flat right now. In fact, for a day or two toward the end of the quarter, it did invert just a touch. And that gets everyone nervous, right? Again, that a recession is perhaps looming. That could, in fact, be the case. But look what we've done here for you. You'll see that just previous time frames where we've had these inversions in the yield curve, the onset of a recession often comes with a good deal of delay. In this data set, you'll see in the lower right-hand corner of the page, 21 months before recessions actually ensue. And moreover, look at the capital market returns in the interim, kind of on post inversion, if you will. They still remain pretty strong for both equities and fixed income. So obviously, it's a tougher arena to navigate right now. Certainly a much more challenging one. Some things in terms of data and trends to be aware of. It certainly, in our estimation, doesn't take you off the track of, obviously, we've got longer term designs with the pension and OPEB plans and trying to use that diversification to weather what is admittedly had been an extraordinarily difficult 3 or 4 months here. If you would quickly, Melissa, just jump 2 pages to 10, just a final set of high-level context for the committee, and then we'll look at the portfolios. No surprises here, right? You'll see year-to-date returns through March across the markets. And I suppose some of the commodity markets, for obvious reasons aside, in the upper right-hand page of the exhibit, really uniformly negative across both fixed income and equity markets for kind of all the reasons we talked of. So just tough sledding, obviously, year to date in markets, and pretty darn indiscriminate. Before we transition over to the portfolios, quickly, any questions from the committee just on bigger picture things or conditions?
Yes, I have one.
Sure, Lisa.
Can you talk to a little bit about housing and rental costs, how you see that impacting the economy and investments? I'm seeing a lot more from just residents concerned about that.
Yeah, I guess I'd answer, Lisa, maybe at a higher level, and we can drill down into the housing cost component. So clearly, right, housing costs are up, wages are up, and the inflation numbers have been just broadly extraordinarily high, right? I think we've been running at, north of 8% on a broad basis. If you strip out food and energy, we've been running at something like 6.5%. So, that's obviously the backdrop, right, against which the Fed is trying to tease rates higher to stifle that a little bit. You started to see anecdotally, though, our kind of base case is inflation is obviously high. It expects to be high near term and elevated like it's been. I think over an intermediate and much longer time frame, it does start to moderate back to numbers that are, somewhat more consistent with history and palatable. Certainly, the housing squeeze and the wage squeeze, is kind of noteworthy, kind of in terms of component parts of inflation. If you look at some of the higher profile areas, however, things like energy costs, which have started to turn over and moderate a little bit. If you look at things like used car prices have started to soften and turn over a little bit. That's a depreciating asset that often can be kind of a leading indicator for all things inflation starting to soften. So you're right. I don't have a better answer for you than a recognition that housing costs are elevated and likely remain that way. And maybe they do press modestly higher in terms of all of the component parts of inflation, but we do think inflation on a whole starts to soften. Your second, part of the question, what it means for investing, I guess there are things right in the portfolio that we've obviously done to try to soften the blow, if you will, to inflation over time. You'll remember we have a measure of real asset. We have things like flexible fixed income, where there's a little bit more wherewithal from an inflation standpoint. Equities, interestingly enough, in the broadest sense, historically tend to be a fairly good hedge against inflation when everything's said and done. So I think on the margin, kind of certainly aware of that. And I think generally we're kind of positioned as best we can be in the context, right, of a diversified portfolio with other objectives to maybe stave off the worst effects of this higher press and inflation. And again, we do think it is kind of nascent, but that you are starting to see some evidence that things are starting to turn over a little bit, if ever so modestly.
I have a question, and I'm
might,
sure that you're probably going to address this, later on, but I just want to make sure I get it out there. When I went through and looked at the information you provided us and could see the kind of the asset spread of where we're invested, it looks like these funds are about 25% in international equities, which it sounds like the returns on those have actually, like you said, been pretty favorable, but it just seems like being that heavily weighted into international right now, obviously with what's going on with Ukraine, but it seems like what I'm hearing is that they're going to have more systemic long-term problems because this is going to impact like the supply chain and what's going on over in the EU. So I'm just wondering how that impacts our risk and our portfolio balance, and if that's something we should be looking at kind of with that as the backdrop. So
it's a great question, and we absolutely will unpack that. So I'm going to just make a note of that so we certainly get to it. Why don't we, did I hear another question as well kind of jump up, or before we?
I was just going to say, Chris, that, you know, from an underwriting standpoint, we've seen rents, more specific to, I think, Lisa's questions on rent, not value or borrowing costs, but rents in particular have risen 15 to 20 in the apartment market, have risen 15 to 20% roughly year over year. But we've seen values been affected by the rising cost of debt. A little bit more modestly in parts of the country where your income to rent ratio, or the amount of income that as a percentage of your overall income to rent is higher. We're seeing it hit those markets a little bit harder, like Southern California. In places like Phoenix, where it's still relatively, I won't say cheap, but it's more affordable to rent a place with rising rents in a place like Phoenix than it is Southern California. We're still seeing those values hold, although I think we're at a point where that's going to start shifting as well. So I would like, we've talked about inflation, but what I'd like to talk about a little bit is this potential stagflation environment that we might be in, with little to no economic growth and still rising costs, whether it's due to China's lockdowns or to the Ukraine. Certainly it's, while I have seen the shelves pretty full, I'm surprised. It seems as though there could be certain issues with supply, maybe a little less so go forward on commodities. We've just seen those run up, and you know, for the most part, developers pass that increased cost directly on to the renter and home building. But any thoughts on stagflation, Chris? Have you heard anything about it?
Yeah, great question. I think, Derek, what we would offer up, right, I think as folks know, right, definitionally, as you know, stagflation, you know, it's kind of satisfied as a condition to the extent that we have no growth, right, and higher.
Yeah.
As you mentioned. And again, I think our base case continues to be that we still eke out, all things considered, a bit in the way of economic growth, and maybe just enough to kind of, you know, stave off, you know, an outright stagflationary period. So it's tough, right?
Okay.
Handicapping the macroeconomic obviously is fraught with peril, as we all know. But as you know,
talk about.
Economists forecast a lot more recessions than we ultimately have. But it's a good point and an important consideration. I do think, right, you put everything together, unfortunately, and I do think the makings of this elevation and volatility that we've seen in capital markets is likely here to stay for the foreseeable future. And, you know, kind of are wringing our hands, and some of these kind of investing consternations, unfortunately, aren't likely going away anytime soon.
Yep.
And, you know, our defense mechanism, as we've talked about a million times, right, is diversification. And I know, I think it was Amber who asked about the international equity. We'll unpack that in just a minute when we look at the portfolios.
Thanks.
Those are
Chris.
all questions. The only other thing I had, I think I had in my notes from our previous meeting, and then I didn't want to catch up just quickly for 30 seconds time. Could you, Melissa, maybe go to 18, PDF page 18, if you would? I think it's where we start with some of our governance information. So this quarter really is a fairly simple and straightforward one on the pension side. It just attends to a portfolio expense. So we do want to, at least on an annual basis, give the committee that perspective, just in terms of costs being borne by the pension plans. And I think if you skip, Melissa, to the very next page, 19, you should have that detail, cataloged here. So I think if you do the arithmetic across kind of the primary components of the fees for the portfolio, obviously the biggest lift is the managers. And you see that a little inside 0.5 percentage point. So 48 basis points, custody cost. And then you also have our fee. And I think if you do the arithmetic on all those, right, it comes to about 57 basis points. So certainly is across $80 million roughly of pension assets. So I guess the statement we would make to the committee is just in terms of our practice and what we see more broadly. I think the fee construct or the fee load being borne by the programs is pretty consistent with what we see elsewhere. And And I think kind of, reasonable, kind of given all the considerations and kind of the different metrics that we look at. So again, no action item for the committee, just more of an FYI. And then the only other thing that I would mention as well, and I think we talked a little bit about this at the last meeting, and we've continued to have some engagement with the Milliman folks, just in terms of run rate for portfolio returns, right? You'll remember at our meeting, at year-end meeting, we talked about the portfolios as they're currently allocated, running to something with our 20-year capital market assumptions of a return of about 6.9%. Right, versus your 6 5/8 versus the contemplated 6.5, and thinking that there was, ample return power in the current allocations to achieve that. If you kind of really want to get acute with it and use our 10-year numbers, right, they kind of come in on the other side of that, and there's about an 80 basis point takedown. So call it, a little north of 6%, and you just kind of simply do the arithmetic, and you've got something akin to a mid-6 type number. So, I mean, I guess what I would offer up, and I think, Lisa, you may have asked this at our last meeting, we think that the portfolio allocations, kind of all things considered, probably are about where they need to be. I do know that Milliman, I think, had pressed a little bit on the idea of reducing those even further. That wouldn't be our central, a tendency, if you will, but I know that you've got kind of multiple points of view as you kind of work through those dynamics. So I don't know if there'd been more conversation with the Milliman folks or other things to investigate, but again, we think you're in pretty good working order from an allocation standpoint. Versus your actuarial target. So I just wanted to update the committee on that. Again, I know we had some ongoing conversations at the last meeting.
Chris, just a quick update. The Board of Finance did adjust the assumption down to 6.5 starting in July 1. And we did engage Milliman to conduct an experience study to get better assessment of our assumptions. And we're waiting on the experience study results.
Okay, and we can, Lisa, obviously, to the extent that you want us to, we can work alongside Jen and the Milliman team and offer our perspective where asked. But we think you're in pretty good working order right now from an allocation perspective. If you would, Melissa, jump, I think it's 23. Page 23, we've done it here. You see here that the content's all the same. It looks a little bit different. We had a change in format that we hope was for the better for committees. So we've got first the town plan catalog, and then we've got the two other portfolios, and we kind of bring it all together. But the upper left-hand corner of the page is, I think, probably of what obviously is of interest to the committee. And you see there the quarter, right, down about 5.7. Benchmark was down 4.6. And again, we can kind of talk to the individual complexions of the manager returns in a minute. And you see kind of the fiscal 1-year numbers, the 3, 5, 10-year numbers, all kind of where they are. It's interesting to me, one of the things that we struggle with as consultants is these endpoint data representations and the relative results. I actually went back and looked at the year-end reports that we had delivered to you folks, and looked at the 1 year, the 3 year, the 10-year numbers, for example, all running ahead of benchmark as recently as a quarter ago. And you get a quarter like we just unrolled, and you see the numbers kind of tilt a little bit the other direction. So listen, a challenging quarter, and obviously an undesirable one from an absolute performance standpoint. No question about it, and a frustrating one. I don't think, again, it takes us off kind of I think the basic tenets that we collectively agree to in terms of the portfolios, right? We know we've got a return objective of X actuarially. We need to achieve that over the long haul. Diversification makes sense at the asset class level, at the manager level, using indexing as we do where it's appropriate makes sense, right? I think we've got kind of the collection, and we'll look at the portfolio in a minute, of kind of attributes in the portfolio that continue to resonate with us, as frustrating as a quarter can be. And I think for those of us who've worked together on this for some time, have had a couple of these quarters, right, where you just get these kind of sharp downdrafts and indiscriminate ones, and it's just frustrating and just something you got to kind of manage through and grit your teeth and move forward. So if you skip ahead to the next page, Melissa, this might get to Amber's question here. We can use this as a proxy for the other plans as well. The town plan, just from an allocation perspective here, you'll see a couple of tendencies, and these are shared across the other two plans, just in terms of marginal over and underweight. So I'm looking at the columns, the asset allocation at point in time, end of March, and the target allocations, and you'll see this again, as I mentioned, across all three portfolios. A little bit underweight fixed income, a nominally overweight domestic equity, maybe Amber, to your point, and then you see where we kind of stand with international equity versus target being a little bit underweight. And then interestingly enough, the Bearing strategy, which you all remember, the real estate strategy, which has kind of a nice yield element to it, a little bit overweight, which we think works nicely in hand with the stated underweight to fixed income. So I think that the allocation expressions, as we stand today, all things considered, are in pretty good working order given the investing circumstances. To the question, which was a good one, on the makeup of global equity. And if you look at domestic and international kind of in conjunction and their target positioning, which is even a little bit accentuated, as we talked about, it's about today consistent with the way global equities profile, right? And kind of domestic is part of the total mix. It's about, from a target perspective, where we stand. So I think, Amber, your point's an important one. Is Europe, for example, a little bit more susceptible perhaps to a recession? Perhaps it is, right? The emerging markets offer kind of, right, an interesting kind of a context as well, because we know what's going on in China with the shutdown, but other areas of the emerging markets actually continue to profile more strongly, and they're kind of directly related to some of these higher input prices. Their economies are, which have been doing well, as you know. So it really is a balancing act. I think you bring it all together. And I think that the general allocation is about where we think it should be from a global equity perspective. The other thing that we don't show in the data, but all know that we've talked about in the past and is important, is working with our research team just alongside these target weightings, if you will, and an opportunity in terms of valuations, right? So the U.S. markets had been so strong for such a long period of time until recently, and their valuations reflect that, right? So in terms of portfolio management context, right, we just want to be aware of over the long haul, knowing that valuations can be an important component to ultimate returns, and international equity valuations, all things equal, are materially lower than their U.S. counterparts. So we just want to be aware of that. I think if push comes to shove here, I think that the larger allocations are about appropriate. I don't think we're over our skis internationally. Again, if you look at the opportunity set and the construct of the opportunity set, and international equities being a pretty significant portion of that, and moreover with the valuation metrics I mentioned, I think that all kind of comes together, and we're, call it, right, 33% domestic equity today, 26 U.S. International, excuse me. That's actually a little bit more U.S. than probably the broad market definition right now, at least on the margin. So I don't know, Amber, if that helped or hurt or whatnot. We're certainly aware of it. We're certainly trying to drive that kind of return stability and diversification by not trying to get too cute over and underweighting asset classes, right? Just kind of based on what we're reading and seeing, and the fact that, for example, is more closely, susceptible, if you will, to recession, obviously is reflected in valuations, and those valuations are a meaningful input on a go-forward basis to potentially higher returns. So,
right. Well, I guess it's kind of like stating the obvious, but I mean, from a fiduciary standpoint and just managing our risk is, I just want to make sure that, we state that we are monitoring this allocation percent. And if we feel like that there's too much, there's starting to be more risk, in the international stocks, that we will take that into account in our overall allocation based on, facts as they continue to develop with what's going on in Ukraine and in China. I mean, the target allocation is what it is right now, but sure, that can change, right? As new facts continue to develop.
Yeah, I mean, remember, it absolutely can. And remember, right, more holistically than this, right? And we did this in the last quarter, and we'll update it as appropriate, as you kind of indicate. To the extent that circumstances get wildly different, we're running our capital market inputs, the basis for this construct that's on the page here, on a monthly basis. And we will obviously be in front of you very proactively if those circumstances change to an extent that drive a new target allocation. You'll obviously hear that from us in real time. So yeah, I think hopefully that there's an assurance to the committee that we're obviously monitoring this more dynamically than, just kind of a periodic exercise that we undertake. So for sure, if something changes there, like you point out, you'll know about it from us, and we'll, make, recommended courses of action in terms of an altered allocation to reflect that. So
Thanks.
Chris, for those, we did not drop to a 6.25% investment assumption rate, but obviously a number of our peer municipalities have, and I think some have even gone to 6. Of those who are using a lesser assumption rate, do they have less international equity exposure?
They have probably, all things equal, Lisa, a little bit more of a conservative allocation, right? So you're calling 67.5, 32.5, equity and other stuff, fixed income, right? Using the target columns. Those that are at 6.25, maybe even 6, and we have a couple of those, don't have quite as much the lift that you do in equity, right? So they're more, they may be more akin to like a 60-40 equity versus fixed income. We've got even a couple that might be 55-45, right, based on a much lower return assumption. So yeah, they do have a different kind of an allocation profile, right? Because they don't need the equity lift that we've got versus the 6.5. So they are a little different. I would say in terms of domestic versus international, though, within the equity portions of the portfolios, at least across our practice, your mix is very consistent with what we see. We start with the premise again, right, of what the opportunity set looks like definitionally, and use that as kind of the base case, and then work from there. So they're not that different when you adjust for the larger equity versus fixed income differences. Does that make sense?
Chris, this is Tom Potter. As far as the international exposure, do you have any more detail on how much is actually China?
You know what, Tom? I meant to, let me come back to you with a specific answer because I don't have it off the top of my head, but we obviously have that data and we'll unpack it. Obviously, within the Vanguard Emerging Market Index, there's an element of that. I think China runs at something like a third of that index or something like that. So it's fairly meaningful. I don't remember on the active strategies, the Hartford and Templeton, exactly what they have there, but a fair question. Let me get the data point for you and we'll send it around to the group right after the call, if that's okay. It's not an overwhelming part of the international, but there's obviously exposure there. So let me get it for you, and I'll send it right out. China kind of presents an interesting kind of set of circumstances right now, right? Is probably in a position, all things equal. Here's the thing: what they've been doing a little bit differently. Obviously, the lockdown in Shanghai kind of changes the algebra a little bit, but actually, China's actually been softening a monetary policy and trying to, elicit economic growth, kind of different than the rest of the world, at least the developed world. So kind of
I agree. I think absent like global politics and, you'd probably have a larger allocation in China, but there's just so much uncertainty given valuations in China. But
exactly. Yeah, well, definitely, but that's a great question. Let me just make a note of it. I don't want to give you an inaccurate number, but I'll get it and send it around. So I used the town plan there. That I do want to be sensitive to time and the rest of the agenda. the detail that follows for the Board of Ed and the police plans, is essentially identical from a performance and allocation perspective to the town plan. So I think my intention would be to maybe skip through those to the extent that we don't have recommendations on those fronts. And then maybe absent any other questions on pension, just spend a minute or two on the OPEB trust quickly before we segue over to Tyler's stuff. So if you, I think it's page, bear with me here, Melissa, 32 maybe? There we go. So a little bit of a different dynamic here, right? Certainly not from an absolute return perspective, $22.3 million, I should say, in terms of invested balances at the end of March. You see that in the upper right-hand corner of the exhibit. Kind of a return figure, right, that kind of in the ballpark of just what happened with the pension plan. So we've got the portfolio down about 5%. Q1, you see the longer dated numbers there, net of fees kind of running again, as we would expect, right? Somewhat akin to benchmark. And running, if you jump to the next page, Melissa, just the allocations there, running pretty close to target weights here, as you see, using the iShare framework that we've, obviously well familiar with. And kind of, again, appropriately diversified across asset class based on our capital market inputs and best expectations, and just running this balanced total return profile that it continues, I think, right? The litmus test there, the longer term numbers have been kind of where we would expect them to be, given, the investment outcomes in markets through time, and well diversified, and the cost on this program, I think we're at 19 basis points for the ETFs when you do the arithmetic there. So, a relatively tidy way just to get at a diversified allocation across markets. So not a whole lot more to add there, relatively straightforward, but happy to entertain any thoughts or questions from the committee on the OPEB. Doesn't sound like there's any, Mr. Chairman, so I will happily turn things over to Tyler if there's no objection to run through the DC programs.
That's great. Thanks, Chris. As always, comprehensive review, and appreciate your comments and feedback.
Great. Thanks, everyone. I will go through the governance calendar, and then this particular quarter is our fee focused quarter. So what I'll do is go through all aspects of the three plans fees, review all expenses, where those expenses are paid, and then of course benchmark those fees for reasonableness. We use a proprietary benchmark that we've created utilizing our own plans, and so you'll see what that looks like. And then again, the town recently did go through an RFP, so obviously through that comes the record keeper negotiations. If the plan shows much higher from a record keeping cost, and again, I'll say record keeper, but that's just the cost that Mission Square / ICMA is charging to do those services, call center, website, statements, etc. We will benchmark those per plan, per size, and make sure that you're comfortable with those fees. And actually, they benchmark very well. On a side note, outside of the governance calendar, a couple things that have come up from an industry standpoint, further consolidation. So if you remember, obviously the defined contribution plan was with Mass Mutual, which was bought by it was with Hartford, which was bought by Mass Mutual, which was then bought by Empower. Empower further bought Prudential. So there's been considerable consolidation within the record keeping business. I co-chair the record keeping oversight committee. So if you do have questions around the record keeper industry, feel free to reach out. And then as a side note, something that we've, that's come up before, with I believe this committee, just via questions. And it's definitely coming up more and more than what was discussed with, over the last 6+ months or so. But Fidelity did announce recently, as recent as last week, that they are adding Bitcoin to the 401k offering. And just if you do have questions around that, the Department of Labor swiftly responded to Fidelity's move towards adding Bitcoin within the defined contribution space, saying that they have grave concerns with what Fidelity has done. So again, I know I'm just tackling a question if it comes up prior to it coming up. We don't recommend Bitcoin as of yet. I think one of the more litigious lawyers, Jerry Schlichter, who sued a lot of the higher education institutions, gave also another warning saying, listen, we don't see it as a offering that is in the exclusive best interest of employees, given that it does have hefty fees, sometimes 20 times higher than the index, and it's lost 40% of its value over the last 6 months. So not just in case it comes up, just in case people are hearing about it, just wanted to address it. But Fidelity did obviously surprise the world with their announcement last week. If you want to go to let's see here, page I'll start on the next page here. Just a reminder, again, as good stewards or fiduciaries of the plan, it's important to make sure that that all costs are necessary and reasonable that are applied to the plan and obviously paid by plan participants. And it's not just understanding the total cost, but all aspects of that cost. What I mean by that is one portion of the fees is for investment management, and the other portion of those fees are for record keeping services. As I mentioned, the call center, the website, the statement. And it's important to benchmark all of those fees and make sure all of those fees are reasonable. And again, apply it from a rational standpoint. Again, the overall fees could be low, but you could have all index investment options, and in an index strategy, it could be in a higher proportionate fee. It's also not important to have a race to the bottom from a fee standpoint. Again, you have to balance what's stated there, fees that are necessary and reasonable. It may be necessary to have educators on staff every day, and obviously there's a cost associated with that. So if your fees were high, it's important to understand why those fees are high, what services are being added that may not be included in a lot of other plans. If you go to the next page, just some context on our survey. So as you see, we work with over 600 defined contribution plans. Again, that's 403Bs, 401Ks, 457 plans. A lot of the very similar work are being done with all of those types of plans. It's across about close to 200 billion in aggregate assets. We take those 600 plus plans. We collect about 100 data points from the record keepers. Plan fees, statistics, features, investment menu design, all things that would apply to fees. We have a significant quality control where we evaluate all of those things, and then we compare those results based on plan by plan. And so as you can see, the numbers of plans we're looking at below, you can see the various subsets that we've created, the 1 to 20, the 20 to 50, the 50 to 100. You can see the number of plans that make up each of those benchmarks. We find this is the best survey that you can use to benchmark your plan, given that all of these plans, of course, have a governance process that benchmark fees, evaluate fees, have a advisor, have a consultant that acts as a negotiator with the record keepers. And so we've used outside surveys, we've used other surveys. We just haven't found the quality control measures up to par that we like, and obviously, they potentially don't have advisors acting on the fiduciary's behalf to further negotiate lower fees. So we feel like this survey not only is a good benchmark, but also a benchmark of what we would consider the A students. We use a lot of the data on the next 3 pages, but I'll summarize that. If we go to page 43, Melissa, or technically it's 40 on the actual deck there. There we go, perfect. The summary of the fees here are reflected. Simsbury 457, the Board of Ed, and the 401A plan. You can see the average weighted cost. So again, depending on where assets are, zero. So we'll just take the 457 plan, 0.55%. Out of that, the record keeping cost is 0.159. So it's not in addition. So out of that 0.55%, roughly 16 basis points are charged for record keeping costs. You can see that benchmark below. We have multiple benchmarks. One is a benchmark that consists of other funds that have the active default target date fund series. And so you can see you're slightly higher than, again, just the average. The average there for a plan 20 to 50 million is 0.48%. Again, you don't fall into that, but we're showing you as you approach that. We show you also the 1 to 20 million, and you're well below that average there in both the active QDIA and the overall average. I will also say, given that you recently did the RFP, that very much helps lowering the overall cost. The average record keeping cost for plans under 20 million is roughly 27 basis points. You're at 16 basis points. So really competitive record keeping costs, I think, across the board. Nothing in this showed that we had to aggressively go back to Mission Square and ask for lower fees. I think Mission Square was very competitive from a record keeping cost when we did the RFP exercise a few years back. If you go to the next page, we look at transactional fees. Again, this is a little tricky with respect to a perfect benchmark, but we like to at least show a range to see if you're, on the higher or lower end. Again, the overall costs, I think, have from a transactional standpoint are very reasonable. Not only Quadro processing, but also distribution fees, seem to be waived for this particular plan. So very competitive fees. It would be one thing if the record keeping costs were very low, but the transactional fees were extremely high, and Mission Square was making up for that low fee on other things. And it doesn't seem to be the case here with the overall cost. I'll pause there to see if there's any questions around fees. Melissa, the next page just gives you an idea of where fees are. Feel free to use that for your own plan, but you can get an idea of, obviously, as planned assets grow, you get access to, lower cost investment options, collective trusts, that more of the billion plus plans tend to get access to either trusts or more heavily weight towards the indexing. And then on the record keeping cost standpoint, you can get an idea of range as well. I get questions sometimes on, that 1 to 20 million, why would one plan be 85 basis points and another be 5? And again, it's purely fee based. There's some payroll companies that are very bare bones and don't provide any service whatsoever, whereas there are some insurance based products that maybe providing a lot of additional services. So it doesn't necessarily mean that anything's right or wrong. If we were much higher than that, say 27 basis point average, you're at 16. If you were much higher than that, we just want to quantify and understand why that is. I apologize, Melissa. I'm just going to go back to one page. It's page 42. Perfect. One concept that has come up, and we will continue to evaluate the impact. We went to a position where we went to the lowest share classes possible for your particular investment offerings. It's sort of what's called institutional share class, where there's no revenue record keeping offset. It's as low cost as we can possibly get upfront for all of the investment options that you qualify for. One challenge that has come up and within the industry is there has been the ability to credit back 12B1 revenue sharing and expenses that are embedded in some of the investment options. And there are instances where, oddly enough, retail share classes can be lower cost if you refund the revenue credit back to participants. I don't want to belabor this. There isn't any broad concerns with your particular plan with this issue. There has been some litigation on much larger plans. Again, one of the biggest issues I'd say would be Fidelity Freedom Funds, the target date funds, where they, oddly enough, the retail share classes are, when you refund revenue, end up being lower cost than the institutional share classes. We recognize the arbitrage that this causes. I think, again, we will consider to monitor this, but no concerns, I'd say, on your plans currently. Any questions on this so far? I'll end on fees with just the trend line on page 47. So again, a couple things. This is all from our survey that we've been doing, dating back all the way to 2012. But you can see plan fees, continued reduction. I think, a movement towards, indexing. I think, efficiencies within record keeping have caused fees to significantly go down. You can see 41% reduction in overall costs in the defined contribution space. One thing of note, and I think we had this conversation when we were originally moving towards the Mission Score platform, we are seeing an uptick in per head record keeping pricing as opposed to asset-based fees. So right now, everyone pays asset-based fees for the record keeping services. As I mentioned, it's that roughly 16 basis points. But on the top right chart, you can see there has definitely been an uptick in people paying per head for record keeping. And what I mean by that is the $1 million balance and the $10,000 balance would pay the exact same fee from a per head standpoint for their statement, their call center, their website, all of the record keeping services that a lot of people believe can somewhat be a commodity. You are still in the majority at 54%, but you can see clearly the shift is moving in the direction of a per head pricing model. We're happy to have that conversation once it becomes a majority. I think, again, there's no right or wrong answer. There's no litigation that says you have to charge an asset-based fee, you have to charge a per head fee. We have some municipalities that have larger unions that say, listen, everyone's going to pay the exact same fee, and that's that. Whereas we have some other municipalities that say, we don't want to have a heavy burden on the smaller balances, the newer participants when it comes to record keeping fees. So just something to consider, but no recommendations currently for a shift out of the current pricing structure. When we get to the balances on page 49, Melissa, you can see the balance shifts again. Obviously, overall reduction in the balances given the market performance. No significant shifts in and out or away from different asset classes, which is good. If there was a big movement out of, say, equities or target date funds into the fixed income or stable value based on market volatility, we'd be a little bit more concerned, but no big concerns there. You can see the balance in the 457 plan, and then of course the Board of Ed, as well as the 401A and the additional in the following pages. Unless there's any questions on fees or balances, I'll touch on the fund performance. We go to 52. So because this is the default investment option, the target date funds, we do like to add some additional clarity around the portfolio and how the target date funds work, because they are dynamic. And again, not much has changed within that strategy. I will note that just a reminder, the glide path for the target date funds is just the name for the decrease in stocks and increase in bonds as someone approaches retirement. So obviously further away from retirement, a younger individual would have higher equity. As they approach retirement and beyond, they'd have less equity and more fixed income. And so T. Rowe Price did announce about 18 months or so ago, we mentioned this during a few quarters ago meeting, that they were increasing their equity position further away and further beyond retirement. And that did come to completion as of this particular quarter. The rationale behind that is that, a lot of data goes into building a glide path. Again, the hopes is that if someone saves the right amount, they'd reach sort of 80% of their income replacement at retirement. And the data that goes into it is obviously mortality, savings rates, behavior, et cetera. And they found that T. Rowe Price found that since the portfolio was launched in 2002, those data points had changed over the last 20 years. One, mortality was increased, so people were living a little bit longer. People were saving a little bit less, and people weren't as skittish with the market volatility. And because of all that, they felt that they could have the leeway to increase the equity glide path further away from retirement and actually further beyond retirement. If you go to the next page, again, the target date fund suite is all on maintain. You can see the market performance here again versus the index versus peers. On the next page, some slight underperformance in the short term. Some of that was from some of their equity managers' underperformance. Some of that was a sort of shift within non-US equities, which was a hindrance to their overall performance. But again, longer term, still performing very well versus peer groups. I won't go into all of the other core managers. Again, a lot of the themes that Chris mentioned before, a few of the managers like Western Asset, I'm sorry, unless I'm on the next page there. Western Asset struggle a little bit, duration positioning and EM exposure. And again, a lot of the themes that Chris mentioned previously apply to the defined contribution plan. A few of the active managers that we don't see in the pension, MFS Value, a fund that's performed fairly well long term, struggle a little bit this current quarter, which is weighing on that 1 and 3 year performance, but longer term performance still well above the index, annualized and above peers from a relative standpoint. Moving on to the next page, I'll touch on a couple funds. T. Rowe Price Growth struggled a lot this last quarter. Again, they were underweight energy, staples and industrials, and the inflationary environment definitely hurt their positioning in a slight position, overweight position in non-US, but their persistent style and I think there's been the headwinds from inflation hurt them on the quarter, but longer term we're still seeing them do fairly well versus half of the peers. All funds are on maintain. We don't recommend any changes. Obviously we counterbalance some of the active managers with the those index funds as well. So we don't recommend any initial changes to the portfolio. And I'll pause there to see if there's any questions around the funds or the fees or current balances in the DC plan.
Just a quick question. I was wondering how many of our investors are in the glide path versus doing their own investment. Do you have a handle on that?
So that's the number of participants I don't have. I have
or percentage.
A percentage. I don't have the percentage of actual participants. I can get that information for you. When it comes to the assets, it represents roughly 19% of the overall assets right now. Again, if you remember, this plan also has a big percentage of assets in the stable value, so that obviously carry over as well. But I can get you a percentage of participants as opposed to the percentage of assets. I would bet that there would be a larger percentage of participants than the asset base, given that they are the default, and more of the newer hires, newer employees are gravitating towards these investment options.
Okay, thank you.
Excellent. That's all I had.
Great, thanks, Tyler, and thanks, Chris, as always. Anything else that the committee would like to discuss? Any open issues, discussion? If not, I can take a motion.
Make a motion to adjourn. This is Tom Potter.
I'll second that motion.
Thank you both. All in favor?
Aye.
Aye.
All right, everybody. Thank you. Thanks so much.
Thank
Enjoy your
you.
week.
Take care, everyone.
Take care.